I just want to invest into one single fund that is good and that's it. Welcome back to my channel, the channel for personal finance and money matters. Remember to subscribe to my channel and turn on the notification bell if you like to watch more videos like this. Hi, my name is Louis, your financial educator. Everybody has a set of their own investment belief and a set of philosophy in managing their portfolio. No right or wrong when it comes to investment. A lot of people told me, I just want to invest into the one single fund that is great, pick a fund that's good for me and I just invest into it. I will always tell them, if you want to invest into one single fund only, then don't look for me. I'm not the good fit for you. In my belief, I'm a big believer of diversification. Yet, some people might argue that unit trust funds are already diversifying into many stocks. Yes, the unit trust fund is already diversifying into many stocks, but every unit trust fund has its mandate to focus into specific sectors, specific geographical areas, or specific asset classes. Not only that, every unit trust fund is managed by a fund manager. You'll be surprised to see two funds that are investing into quite similar stocks, yet one performs much better than the other one. The reason is the fund manager. So a good fund manager knows how to invest, when to invest, what to invest, when to get out of the market, when to keep cash. In my own experience, I've seen two funds that are exactly the same, invested in the same stocks, yet one fund performed 15% much better than the other one. You might say, Louis, then you just pick the fund that is managed by the good fund manager for me. I know what you are thinking, but if you are just investing into one fund, then you are putting yourself in a very high risk situation as well. That's because there is never a single asset class that can perform continuously for every single year. On the other hand, there is never a single asset class that can perform badly continuously for every single year. In general, there are many asset classes, for example, large cap stocks, small cap stocks, international developed stocks, emerging market stocks, REITs, high grade bonds, high yield bonds, and cash. The key here is you do not want to focus into one single asset class to risk your investment value. Rather than that, you should diversify your investment into these asset classes and make your ideal portfolio. The sage expression, "Don't put all your eggs in the same basket," describes the essence of diversification because it illustrates the need to spread your risk across several areas. Put differently, if you put all your money into one investment, you are probably not diversified. But here's where investors often make their biggest mistake with diversification. They think that diversification can be achieved if they simply spread their money across several different unit trust funds. But if you put your eggs into different baskets that share virtually the same characteristics, that's not diversification. When deciding on how many unit trust funds and which funds you should have in your portfolio, aim for diversification in your portfolio at two levels: across asset classes like stocks, bonds, and cash, and within asset categories, industries, and companies. The underlying securities in the unit trust funds you hold can be as big a determinant of how diversified your portfolio is as the number of funds you hold. Diversification across asset classes. A portfolio that is exclusively invested or too heavily weighted in stocks might sound good in theory because stocks can rise dramatically in price during an economic boom, and you might reap the rewards in the form of higher return. But it's risky because it subjects your portfolio to outsized losses in the stock portion of your portfolio and significant declines in the overall value of your portfolio when the market declines. On the flip side, investing too much in cash or otherwise incorporating too little risk in your portfolio may mean that it doesn't generate sufficient returns to meet your goals. To balance risk and reward, spread your money across the different asset classes you choose: stocks, bonds, and cash, for example. The specific spread you choose should factor in these key criteria. Investment goal. You might be investing for capital appreciation, growth of the investment over time, or income, for example. If capital appreciation is your goal, you might want to weight your portfolio more heavily towards stock than someone who wants to draw a steady income. Risk tolerance. Risk refers to the potential to lose the money you invest. Assets that carry greater returns also tend to come with greater risk. If you have a high risk tolerance, you might put more of your money in stock. If you are extremely risk averse, you might want to put more of your money in money market funds. time horizon. This is the period over which you plan to invest. Generally, investors with a long time horizon can take more risks and invest more heavily in stocks than those who only intend to invest over a short period. Someone nearing retirement, for example. Asset category diversification. Although you may have several different funds in your portfolio, if some or all of them have the same or similar holdings, your portfolio has a major flaw known as fund overlap, as I have mentioned before. To avoid making this mistake, pick unit trust funds with holdings in different asset categories. For example, a simple 4-fund allocation that is diversified could include one large cap stock fund, one small cap stock fund, one international stock fund, and one bond fund. Each of these will likely hold completely different securities. But it's still important to review the underlying holdings of any funds you add to your portfolio to ensure that they don't have overlap. How many unit trust funds you should hold? There's no magic number of funds to keep for long-term investing. The right number of investments is one that ensures diversification but also factors in your investment approach. If you prefer low-effort investing, consider buying one single fund. If you are prepared for more administrative work when it's time to rebalance your portfolio, choosing up to 8 offers an opportunity to increase the number of asset categories you include in your portfolio. No matter how many funds you settle on, you can likely put together a portfolio that accommodates your choice. That's it. Remember to invest at your own risk. The most important thing is to engage with a unit trust consultant to understand more if you would like to start with unit trust investments. Like this video if you find it useful, and remember to subscribe to my channel. Thanks for watching. See you in the next video.